Hey, this is Cece. Welcome to the Orbit. It is Friday, January 5th. We've got futures slightly in the red, not too big of a reaction to the non-farm payrolls number that just came in earlier this morning, and it was hotter than expected. That does have treasury yields once again higher. It's been the quiet story of the last week and a half or 2 weeks of this holiday trading is treasury yields stopped going lower. And this is sort of across the board for all the way from the 1 year out to 20. And what it has done is it's sort of slowed the momentum of some of that year end, that rally into year end. We've seen some stocks pull back, especially the first couple of days of the year, but it was sort of quietly happening in the last few days of 2023. We've got we're looking at the TLT right now. You can sort of see what's happened over the last 2 weeks. That TLT pullback is with treasury yields rising. Now, of course, the story here is that it hopes of a rate cut this spring by the Federal Reserve, if the numbers keep coming in hotter like this, the jobs number, or if when we start to see more inflation data over the next couple of weeks, if that is not continuing its trend, then it becomes less and less likely that the Fed is reducing rates this spring. And if they are doing so, it would have tended to be either to normalize rates, which probably would have still been fairly bullish for the market, or it would have been in softening metrics in the economy that they started to become concerned about. That probably would not be good for the market. Right now, the story, the narrative is changing to probably just higher rates for longer. And where does that affect stocks? Well, it's not necessarily a negative for a lot of stocks, but it could stop being a positive in some stocks. And maybe that's what IWM has been telling us the last week and a half. You see that pullback. IWM was trying to break out above 200. It failed up above 205 to sort of pull away from that gravitational pull of 200. It is now below. It has already moved with this pre-market move. It has already moved more than the expected move had for the week. But it could recover. It's something to keep an eye on. Is that 200 level still a center of gravity? It's 2000 in the Russell if you're looking at the index. Is that still a center of gravity, or is it hit escape velocity to the downside? And a lot of this probably will depend on those treasury yields. So keep an eye on those 2 year treasury yields, 1 year treasury yields, 10 years, those kinds of things if you are investing and trading, especially in small caps, because they are probably driving a lot of this movement at this point. Looking at the Qs, again, barely moving, slightly in the red. We'll see how that plays out. Now, the fact that the number came in hotter than expected and you don't see a massive negative reaction is potentially stocks were getting ahead of that and traders were getting ahead of that. There were a lot of gains going into year end. We saw some selling. We saw some mega caps selling the first couple of days of 2024. Perhaps there was some nervousness going into this. We obviously had a 0.7% expected move in Qs, which isn't massive, but if you do go back to the SPY, we had a 0.6% expected move, which is for 0 DTE today. That's the highest that we've really seen over the last few weeks. These 0 DTE expected moves in SPY and SPX have tended to be more about 0.4 and under 0.5, some days 0.5. So 0.6, the market was expecting a little bit of volatility into today. And so far, we are not seeing that. So keep an eye on that. Maybe the market was a little bit ahead of that. Now, obviously, from a volatility perspective, we are still very low. Now, what would change that? It would change that with that 0 DT expected move is something to keep an eye on. Take note of that in the morning. If you see a 0.6% expected move and you continually see moves in the market of over 1%, clearly volatility is wrong near term. And that starts to feed into even like 2 weeks, 3 weeks, and then suddenly 2 months out. If that's consistently, if option sellers are getting burned on low volatility near term, that starts to feed into the rest of the options chain. right now we are sort of low across the board. Any options trader looking to make a position out a couple of months, it's extremely low volatility. And that's also, traders should start to look at that earnings calendar coming up. Earnings, we are in that breather period of a couple of weeks, but earnings start back up in January. And you've got, if you have some positions already in some stocks that are about to report, or you have your eye on some stocks about to report, take a look at some of that option vol out, beyond earnings, that capture earnings. It's still fairly on the low side, and you're unlikely to get burned on any sort of decay or vol collapse because that earnings will hold that vol higher.